learned to an election. Live in the hills, but I still get a spread. Started with a little, but I still reinvest it. Fear how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down, hold it down, we gon' get it.
All right, ladies and gentlemen, I hope you're having a wonderful weekend or whenever you're watching this video. Today, we are going to talk about my $40,000 long-term investment dividend portfolio, stock market portfolio, whatever you want to call it, many, many names. But fortunately for us here in this account, we actually have a mix of both dividend stocks and growth stocks. So I want to talk about how we did this. We actually did this just about 1 year ago is when we created the account. You could see the low is $500 and the high was $43,000. Today we're sitting at $42,000. So we have two different accounts, one with $4,000 and one with $38,000. This big account, we deposit $2,000 a month. This small account, we do $200 a month. So now why I'm telling you this, why did we create these accounts? We did this 1 year ago to show and highlight the importance of long-term investing. So we have a lot of option trading on the channel. We have a live stream, youtube.com/the-stock-market. You can watch us trade live every single day, and every single one of these purchases was done live. So this is our long-term chair. We call it the chair, long-term shares, chair. Yeah, it's like my dad say, you know. But the idea with this is we are planning to hold these long-term. We supplement it with option trading and all that. So now what I want to show you guys in this video, a lot of people ask about the stocks. I want to go over every single stock in the portfolio, give you a little bit, not too much on why I like it. Again, there's going to be a lot to go over, but I want to focus on how we build it and go through every single purchase throughout the year. So as I've already pointed out, we've deposited monthly into this account and we've made two different sizes. When we made this account, we wanted you guys to see the importance and power of long-term investing, whether it was even $200, even less, or even if you wanted to use a big amount. We used the same exact strategy. We were able to scale it. But one of the main points and the power that you get from building out this portfolio, and you'll see, I want to show you how we build it, it comes from depositing monthly and using your balance over time. We were never fully invested, and that's the best part. You could see when we made both of these accounts since October, it was kind of slow at first, but this was March. This was one of the worst times in the stock market ever in history. So we've seen a lot of different things happen 2020 in general, but we were still able to come out a winner. So like I said, we are going to make this a little bit interactive. I'll show you some of the stuff we have, but one of the main points here is the overall gain. So on the big account, we call it my mom's long-term because I wanted to show her. Again, we wanted to show a lot of people. My mom thinks stocks are risky. I'm sure a lot of your moms do too maybe, but we did 13% at the end of the year on the big account. And then for the smaller account, we did much better, 27%. So again, considering the context, considering this is just like a glorified savings account, it's a really, really nice return. That's one of the first parts. The next thing that we need to get out of the way here is the dividends versus the total amount of growth. So again, both accounts have a value of about $42,800. You guys can see that over here. This is the combined value. But now when we go back to the dividend calculator here, this is showing all of the positions we have. We have $17,000 in dividend stocks or stocks that pay dividend. Our average yield is about 5.7%, gives us about $85 a month. And yes, we have it all on dividend reinvestment. So that's one of the biggest things we focused on since we made this account, and we have yet to even see its powerful effects yet, but we are reinvesting all dividends. But now this portfolio itself is paying about $1,000 a year in guaranteed income. But the part we like to highlight when we set out and made this portfolio, this is I guess one of the other main rules. I'm giving you guys all the little hints here, but we said invest in stuff that you think is going to be here in 10 years. Anybody could say this is a good stock, a bad stock. Wall Street's been right and wrong many different times. The idea is most of the big names you've seen now today, you've known about. You've seen them happen right before your eyes. It didn't really require a Wall Street education to understand that, to see, you know, what a good company is, or is something going to be profitable in the long run. And that is the point. We're holding these for a long time. Long-term chair, Habibi. So what we've always said is go after companies, you know, get some bulletproof ones that you know about that have a good history, aren't going anywhere, have already made billions and billions of dollars year after year consistently, and then pick some that you think will be around here to stay, stuff that you interact with, companies you actually know about or could see their value or disruption ability, whatever it may be. That's what brings us to this point, because now here is the calculator. We always said either 60-40 or 70-30, depending on how old you are. Again, I'm a little bit younger, so I've want to aim for more towards growth. And that's even why I'm showing you guys this video here too. Coming into this next year, you'll see how that strategy is going to change, and you'll see where I'm at now. I want more growth than low dividend stocks. However, what the market is presented and what we've ended up here, we've ended about 60-40. So again, we have about $17,773.82 in dividend stocks. Divide that by the total portfolio value of $42,858.33. That leaves us with about 41%. So about 41% of the whole portfolio is paying dividends in most of these companies. A lot of people, you could argue whether or not they're good or bad, but they pay dividends. It's again, that's why we're calling our slow stocks. We're not really seeking these stocks to go crazy and make us big returns like Amazon, Tesla, anything of that nature. Putting all of those little things into play, just in 5 minutes, this is all we've done to build this account, and I'm going to show you. We went after companies that we thought are going to be here, and then we invested a smaller amount in dividend-paying companies we know about. We deposited monthly and just used whatever amount we had monthly. You have a starting amount. You have $10, $20, $30, $50,000, even $5. Don't put it all in at once. We put all of it in month after month, spaced out the purchases, use that to our advantage. And it doesn't really matter what's going on in the market. Even though this was the craziest market, the market did a lot, but our strategy stayed consistent. It was able to produce a pretty good return. So now that we have got that out of the way, I want to focus on now each of the stocks and then really how we've gone about purchasing them, the timing, and even companies that are even new to the portfolio that when we started this, again, we had made a video talking about exactly what companies we wanted a year ago. We kept most of those. We kept all of those. And then we added a few ones we liked. And now that even brings up another point. A lot of you guys have these long-term portfolios. Maybe you've bought something you don't like or it's not done good. We did that with Disney and Walgreens over here. I ended up buying Walgreens on the bigger account once it got dramatically cheaper and it made more sense. We'll talk about that. But pretty much, we never want to sell anything in this portfolio. So at any time there's a position you don't like, instead of selling it off and trying to time it and this and that, you just stop adding to it. And remember, you're depositing monthly. You're already working with a limited budget. You add and build different positions. And that has been another key too, building positions. And you will see that through the purchase history. So we will come to this platform again that it shows us a little bit, but to kind of make it a little bit more clear, I'll just show you guys here on the portfolio. If we come to our positions, here are all of the positions in this small portfolio. I will arrange them by market value so you could see by the end of the year which ones did we end up with most money in. So the first one is Spotify. We only have 5 shares. We spent $755 for those 5 shares, but now it's worth $12.50. We have a 65% gain. So we bought this one in different increments. We'll go over that, why we like Spotify. This is one of those companies that I think is going to be here in 10 years. We use it. Again, I'm not using any sophisticated Wall Street analysis except for I like it and I think it's going to be here in 10 years and I can kind of see it used by everybody. Second one is Snapchat. I really like this. I made videos on it. Same logic with it. Has different advantages and weaknesses. There's like it appeals to teens and all that, but I think this is one that's going to be here in 10 years, especially with how we've seen social media explode, but even new ones like even TikTok and all that. I think it's interesting, but another great pick of ours that we've liked. We spent only $350 for these 29 shares on this account, but now they're worth $783. We made 121% on the year on that gain. Then the third position, another one of my favorite. This one pays a dividend. This is also a value stock, more or less, but it does have some growth with it. Abivai. We paid $640 for these 8.2 shares, and now we have 0.23 because that's the dividend reinvestment. So these stocks pay dividends. Instead of taking the cash, we've reinvested it and turned into shares. So the idea is over the years that will compound, the drip into a huge fountain. But we're up about 12% on that one. I like them. These guys own Botox. They also own Humira, one of the leading anti-inflammatory drugs. However, in a few years, they are going to lose that, and it does pose some risk. They are a spinoff from Abbott. I like them because it's medical, and they have just a really extensive pipeline, and they already have their hands now. They've been purchasing companies that will keep them around. Again, this is a value stock, so the real risk to this one would be it turning into one of those value stocks where it just really loses some of that pop and upside to it. If the Humira thing goes bad, the pipeline isn't good, Botox, everything else from Allergen doesn't hold up, they would be yielding a lot more and then we'd lose a lot in equity. But I don't think that's going to happen. We'll see though, but that is one of the risks. The next position, this is a new one. I just recently grabbed this one. We just added this one, but it was not on the original list, but I like it. I think it's going to be here, and you could see kind of based on the industries, I don't really have exposure into like retail or something like cosmetics or just a basic commodity type company. So I went with Ulta. Shout out out to the ladies. I love this company. I think it's there. I've seen it a lot. I'm sure some of the fellas out there, the ladies definitely know, but went small, only 2 stocks. We paid $4.64. It's only worth $4.67. So we're only up 0.5%. The next stock is AT&T, and again, even while I'm explaining all this, you guys will see, even though this is the small $4,000 account, this is scalable, and most of these companies are going to cross over to the big one. I got the same one. I have AT&T on the other one, but we got 12 shares, spent $388 for them, but now they're worth $347, actually down 10%. Pays about like a 5 to 8% dividend, so it kind of balances out. But the logic here with AT&T, it's a value stock. I've always said, even with the phone service, just go with the company you pay. Go with your own phone provider. But I was looking at Verizon. They looked a little bit better. AT&T, Verizon, 5G exposure too, but just solid dividend aristocrats at the very least. Their dividend has been very, very consistent. Then to the next one, another dividend stock. This is a high-yielding REIT, a real estate investment trust. We are down 7% on this one. So we have, we spent more than it's worth, but this one yields about 9%. So actually, even though we're down 7% on the year, if it paid us 9% in yield, you actually just broke even, and now we just have more shares and we get to hold it. So that's usually what happens with REIT in these value stocks, is that even though they could go down some years, the idea is the dividend should be able to offset that and help you on the upside. So there's IRM, then another one. This one's a new one. We didn't have this on the original one, but I liked it because it has growth, but it's related to kind of the real estate industry. Even it'd be like investing in our competitors, but I like it. Rocket Mortgage, we're up 1% on it. We just recently grabbed that, but I used the monthly deposit, $200, grabbed 10 shares. We're holding that. Then Beyond Meat, this was a growth one, and the best part I like about this one, I only bought 1 share. I spent $78, but we have 148% gain, and it's actually returned to us more profit than most of the picks just off of 1 share. And that's the idea, is that you don't need a lot of shares. It's all about the market value, what you have invested. That's why I've been showing you guys $17,000 dividend, the overall portfolio. It's all about the amount invested rather than the price of the shares. Because again, we've bought bigger companies. It didn't matter if they were expensive or not. You're still getting a return. A return is a return, especially nowadays. You could buy fractional shares with most brokerages. There's nothing really holding you back. Then Disney, I grabbed this. We grabbed this earlier. I liked it, but why I said I don't like it, we're down on it 13%, but it stopped paying dividends, so pretty much I just stopped adding to it. Walgreens is similar, and we're going to talk about this one, but we bought this early in the long-term portfolio, kind of like off a buyout rumor, and it never really did good and ended up dropping 41%. So I just held it, never added to it, them and Disney. And that's what happens, is that we built different positions. And then finally, Altria, only $92, down 5%, but it yields that same amount. So that's about break even. So those are all of the positions in the small account. We're going to come over to the bigger account here. And what you will notice, it's very, very similar. There's just a few different companies. As you see, Snapchat, we have that. That's our biggest holding in the main one. We have about $18,000 in it. The next position, Abivai, $8,000 in that one. Uber is a new position we didn't think about, but this is like I'm saying, I think it'll be here. I think this is one of those companies. It's kind of obvious. You see it right in front of you. I'm sure 5-10 years from now, you'll be like, oh, no way. But even if it's not maybe Lyft, it could still fail. Again, that's the idea. That's why we're picking and choosing. And then over the years, that's why this is just year one. You guys are going to see how it's evolving, and it's already evolved, and we've already branched off a little bit. But the idea is go slow month by month. Things take time, even greatness. So you don't need to really rush too heavy into anything and kind of, let the tree grow. But that one's new. Walgreens, you see that was there. And eventually I just got this one, and we're up on this one almost 1%, but I bought 100 shares of it because eventually we were down so much on the other portfolio. I looked at it, even now the dividend, just kind of the company itself, the fact I bought it almost a year ago for buyout potential. I said, I like it. It's a solid dividend one. Let's get it in there. You got a lot of bang for your buck, and that's something moving forward this year with this portfolio. Although I do want growth, the idea is what I've been seeing, and you could see it with the gains that we've had on different companies. You're making a lot of money on growth right now. Growth is really expensive, but some of these value stocks are very, very cheap, ones with even good dividends or good historical dividends. So although I want growth, I will be focusing where I'm going to be getting my best value building this out into 2021. But you guys saw Walgreens, then DraftKings. This was a new one we added, grabbed 50 shares of those. We're up 17%. We're up even more. They've been coming down recently, but this was a new one. I like it. Again, been seeing them on NFL commercials, all that. I think this is one we'll see. It'll be here. But as you kind of put this full circle, think Uber, Snapchat, DraftKings. You may not like them, but at the end of the day, all of these would need to fail for me to really get clapped in the long run. But if one of them ends up being a unicorn, it'll be good. And then finally, MO and AT&T, those were the same exact ones in the small account, but just bigger positions. And then Coca-Cola, this was a very good pickup. We're even up 16% on it. This was during the dip during March or April when things were going bad. So why did we add Coca-Cola? Because the yield started changing. So Coca-Cola is a solid bulletproof company. I liked it, but for most of the year, this has like been a 2%, 1% yielding stock. Then all of a sudden, Coca-Cola dropped a ton, and it was a 4% yielder. So I was like, hey, that's a great yield. At the price point, we could pick up those shares and yield 4%. I said, let me get that. So I started scaling in. Then eventually, it started shooting up faster than I could get more. But you see, we have the drip, we have that, and those are pretty much the only differences between the plays. So now the next main part is actually building this. So here's the whole 1 year history. You could even see here, I can't even go back one day because this account didn't exist. So we've had this for literally a year. This whole account, this is the 1 year of everything that we've done, deposits, all of that. You could see every single thing. So to begin, I want to make this a little bit interactive so you guys could see, again, how we built out this portfolio. And the point you need to watch from here is how we literally built out positions. So don't forget the visual. You're depositing every month. Your balance is going to be limited. Some stocks are going to be more expensive, whatever it may be. Stocks are going to move up and down. Maybe some are going to be a better price than not. That's what we talked about when we made this. You're going to see that over the months and over the years. Some stocks will become better deals. Your dollar will get more or less strength. So what we did is, remember, we finally decided after waiting a few days, we're going to start establishing the few positions. So on this first day, on October 14th, we grabbed a few sets of positions. I grabbed one growth. I bought one Spotify at $1.1480, two AT&Ts at $37.63, and then three IRMs at $32.26. So remember, we started this account with $500, so we spent the first like $200 establishing those three positions. So here's Spotify. There's our 114 pickup on October 10th, 2019. That was a nice one. And then AT&T, we got two at 37. So you could see we were on the exact opposite end of that chart. We were up here when we got it. So there's October 14th, $37 around there. And then October 14th, we also got the IRMs. So right there at 22, a little bit high in the middle. And again, those are the two value stocks we were down on. So let's come back to the next day. The next day, we made more purchases. I grabbed two Altrias at $42.93. And then we got 9 Snap. We spent $125. And I think then that was our first month of purchases. But looking here, Altria, October, where was it? Around 42 we spent, so $42.93. Not actually too bad from where it's at. That one kind of stayed the same. And then Glorious Snapchat, we got in around like $13.80, and then it's almost up. Man, it's up over 100% since then. It's crazy. But that was the first month. Then it was towards the end of the month. I fronted myself an extra 100. There was a Fitbit buyout. Remember, we got that. There's a rumor of it. We got 50 shares. Ended up selling it out after Google bought them. And then we grabbed one share of Abivite at $79.30 on October. I was sold out the rest of that Fitbit. We got some cash, and then pretty much that whole month we didn't do anything. All I did was grab that one Abivite end of October, waited a month, and then end of the month we made our deposit for $200. So then that same day or later that day, Beyond Meat, grab one share at $78. Remember, that's the same one we're holding. We got that $11.25. So that was like around here. It's kind of crazy. Look at that. That was from the low of the IPO. So pretty decent, but then it's almost been that almost 2 months, and that's all we've picked up. Our initial 5 companies we wanted. Oh, there's the Walgreens. I forgot. That was after the buyout too. We got clapped on that. This $2,000 was I made the big account. So the big account started 2 months later. I didn't have the account set up, so I deposited, had to transfer it out. Then we got our dividends on Walgreens. Then we bought a fractional share. That's the dividend reinvestment. All of December, didn't buy anything else, just held the cash. And this is where you're starting to see we had our positions. We're holding 2 months now. The stock market has been going up at that point, or things were going up. We said, we'll wait. We'll build up our deposits. Got another $200. Some of these dividends, I bought that one Disney share on the 6th. Then I grabbed one share of Spotify and then 2 shares of Abivite. So again, we were stacking up some of those deposits, so we had a little bit more money to spend. So to visualize this, you could kind of see now it's coming January. We bought Spotify over here. The stock shot up, and this is when I actually bought into that was going up. I bought into it going up. Used one of the deposits there. Then AbiVi, same exact thing. It was shooting up. So I averaged on both of these. I like these companies. I just didn't want to buy at that point. I wasn't really feeling getting AT&T more at this high. I did add Disney. So again, we kind of liked it. It was coming off of news, the Disney Plus. Little did we know COVID and the dividend cut would happen. But I was like, okay, we'll add another position. But you could kind of see how I waited, built out, and then went for the ones that I even liked. And I was building a position. As you could see, we bought Spotify early. We're building, waiting and saving and adding to that. AbiVi, I'm adding to that, putting most of the deposit there. So then we get some dividends. We make another deposit February, 200, get more dividends. You can see these are all dividend reinvestments. It looks small. Don't buy anything in February. We get the dividend in March. Don't really buy anything in March except for a few days later because Snap starts to drop. So this is when everything starts to really, really go crazy. So March 10th, I had the money. I was saving up all those deposits. I spent a little bit more than 1 month to get 20 shares at 11.40. So that ended up being a pretty good pickup. But then you kind of come back here. What did we do from there? I waited, got more dividends, added another month. So remember, I had 2 deposits we saved up, only used one of them. Then we're adding. So you could see I'm holding stocks, adding cash, and then we're waiting. And then eventually what happened there too, Snap was the only purchase in March. And then in April, after the deposit, I had a little bit more cash. Again, we had a balance. We're stacking up with cash. So I bought 5 AbiVi at 72.80. So this was kind of in the peak of everything. You could see here, we used that dip opportunity. I grabbed the biggest amount of AbiVi, just like I did with the Snapchat. Got the biggest amounts at a pretty good discount. So we got those at 72.89. That was our purchases for April. Again, got a little bit more dividends, made our deposit in May, and then we gave ourselves an extra bonus there too. We were saving pretty good. So we're stacking up all this cash here, getting more dividends, more dividends. As you can see, we're getting like $9. All of these got reinvested. That's why we have the fractionals. And then come middle of May, we bought 3 more spot. This was, I think, right before the Joe Rogan news or on that news. But May 18th, remember, we bought into the first run up, but now where's May 18th? We literally waited till it got right back on there on that same price move and everything. We like this stock. We've been holding it even though we bought it at a cheap price. Other stuff was already bouncing. We already had stuff we were up and down on. We had good pickups on Snapchat and AbiVi. I'm aiming for growth, like I said, especially on the smaller account. So I went and I got now those 3 shares spent like $4.84. That was middle of May. Then we added another deposit in June. I got 3 AT&T finally in June. I waited because now you could see up until June, we were really just buying growth stocks for the most part. So I kind of wanted to balance it out a little bit. I only spent $100 there, but I ended up actually even getting it there on the pop. So came down a little bit, but I made that purchase and then had a little blunder, accidentally bought a call on this account. I got confused, but then we bought those in June, waited a little bit more, made another deposit. I even waited until July 1st, got more AT&T. So then you could see we were buying growth. All the growth was ripping by this point. If you guys come to the charts, think about AbiVi at this point, Spotify, even if we pull up Snapchat, you can see everything was really, really high from when we bought it. So I was like, okay, now I'll start focusing on my dividend one. So then I started picking up AT&T a little bit more July 1st. So then we went there, more dividends, more reinvestment, made our deposit for October or for August. More dividends. I don't think we bought anything else in August. Oh, end of the month, I got those 2 Ulta shares. So at this point too, I didn't want to keep adding it. I spent 2 months buying some dividends, so I was waiting a little bit. So I said, well, wait. But I wanted some growth. I did want to wait a little bit, but I liked that. I said this is when we could start building into this next year. Grabbed that, had the deposit the next day, bought IRM now. So this is my first IRM purchase since the beginning of the year. So you can see how I waited, bought the growth early. All of the growth started ripping, and then we waited pretty much when all of the growth got expensive. Now I finally started digging my teeth into some of these dividends. Interestingly, bad timing, though, when I'm buying these on the highs, but we still got them. We're holding. Got there on September, and then that brings us to where we're at now. We just had our final deposit in October, and then I got those RKTs, and that's it. That's every single transaction now. And that is what has created this YouTube long portfolio here. You guys are seeing that's every single purchase. I didn't do much. We just deposited, waited. You could have looked at it here and there. You could have even bought, and you've seen my timing on a lot of them was pretty bad. Some was better than others, but it's time in the market, not timing the market. But that yielded a 27% total return on that account. Like any long-term or a good one, it looks pretty. You can see we started with 500, but this is how we actually built a portfolio, a smaller one, but the idea is we built it. It was a strategy that allowed the money to grow, kept our money in a safe place, still has a lot of upside for the future, and is relatively protected because now the longer you own stocks, the less riskier they become, and we've got to put a little bit of time under our belt. So that was every single transaction on this small account, but now let's go to the big account. Very simple. We did a little bit trickery here. We got that first deposit of cash. This one, there's just a lot less transactions, I believe. This one should be easier to go through. I won't go through on the charts, but I started selling Snap puts, and then we would take the premium sales and then use that to buy shares. But eventually, I just ended up buying 100 shares of Snap, waited about 2 weeks from the first deposit, sold calls on it, took the profit from selling covered calls, bought more shares with it. So it's crazy to think about. That's almost doubled up for us, but did that. Then I also got $300 at AT&T. That's the first $2,000. I went growth and a little bit of dividend. So I was buying AT&T on the bigger one, made our deposit. We got our bonus right away. I did $2,000 or another 100 shares of Snap at 16, did the covered call, reinvested the profits. Then we started buying Abivai. Bought 2 different positions throughout the week. I gave it some time, split them up, pretty much spent the same amount. So now you can see we kept building up growth in Snapchat. Instead of getting AT&T, I started building up Abivai, bought more Snapchat, bought more Abivai that month. Again, we gave ourselves that bonus, waited a month, February, got our deposit. There's our dividends and our reinvestment. Bought 100 more shares of Snap in February. I think I gave myself another bonus on there, did we? I think we that or oh no. This one we were catching up. I forgot. We had to catch up because we were behind a month. But then we used that to get 50 shares dividend stock. So again, these got a little bit cheaper during March. I bought dividends instead of growth. Clearly, growth would have been the better winner there, as you saw in some of the other purchases. But then we also grabbed another 100 shares of Snapchat at $13.5. And if you guys want to know the best part about that, this was because it was a sold put. I sold a put on Snapchat and got $41 agreeing to buy 100 shares at $13.5, and I got assigned. But that was fine with me because we ended up keeping that $40 and we got to buy the shares. So then we made another deposit. Now it's April. I got Coca-Cola. I said I'll scale in, and then it just kept going up after that. It was a little too late, but we got those shares of Coca-Cola, went a little bit more dividends, sold more covered calls on Snapchat, bought more of the shares with Snapchat, didn't buy anything else, made the next deposit for May, got more dividends, more covered calls and rollovers. And then in May, we got 100 shares of Uber. Again, things were bouncing at that point. We already got some of our pickups. So I started looking around, other stuff that was kind of more attractive. Sold a covered call on Uber and then turned that into 5 shares. Dividend on Abivai, that was the month of May. Then come June, we made our deposit, got 41 more shares of Abivai at 90, so the price was a little bit higher. That was the whole month of July, didn't do much, and you could even see our Altrias are paying us now. The dividend would get us actually more than 1 share in drip, so every single quarter we're getting a free share, but that was July. Then comes August. I bought 150 more Snapchats at $22.76 at the end of August. Then gave another deposit because I said, I was like, all right, I want another bonus. Because I did say I am going to keep buying more shares of Snapchat. I said in that video $2,000. So then gave myself a bonus just for Snapchat. Got 100 more. Again, I like Snapchat, and we've been building that growth. Got our deposit for that month. Bought DraftKings. I liked it. Newer pick. Then we got 100 shares of Walgreens, and that leaves us to here we are. Then Abivai too. But the bigger one was really, again, more concentrated, and you saw how we had a little bit more newer picks at the end. But I'm recently just been adding to this more. We've been doing a lot of waiting. So this has already been a very, very long video. This is the long term. I hope you guys have had better performance. I hope you guys make a long term above all else, and that this video helps. But that is it. Let me know if you have any questions. If you have any recommendations, stock picks, anything, what you think we should do with this, post that below. I love you all, and shout out to the long-term chair and chat, baby. Let's go.